I'm Andy Panko, owner of Tenon Financial. Welcome to Retirement Planning Demystified. This is part 2 of the series on how to find a financial advisor. If you haven't already, be sure to watch part 1 as the content in this and the third video build off what's in the first video. This video will explain the products and services offered by the different types of financial advisors, how advisors are compensated, and what all the different letters and designations are after financial advisors' names. I'll also touch on the conflicts of interest in the industry and the significance of what it means to be fee only. All right, let's get into it. There's a lot of variation in the products and services advisors offer. This is also driven by how the advisor is regulated, as discussed in the first video. Insurance agents are licensed to sell insurance products, which includes term life insurance, whole life insurance, universal life insurance, annuities, and property and casualty insurance such as homeowners or autos insurance. Securities brokers are licensed to sell securities, which include stocks, bonds, mutual funds, closed-end funds, exchange-traded funds, real estate investment trusts, and so forth. Investment advisors provide investment management, which is when they have discretion to make investment purchase and sale decisions on your behalf in your investment account. Basically, they advise you on which particular investments to buy or sell and when. Persons regulated as investment advisors may also offer standalone financial advice not tied to providing investment management. Remember the example in part 1 of you wanting to pay someone for a few hours of their time and advice? An advisor who provides such services will be registered as an investment advisor. Insurance agents and securities brokers generally are not able to offer advice in exchange for direct payment. Their financial advice is only allowed to be incidental to the sale of their products. Not to get off on too much of a tangent, but you've probably noticed there is no separate set of regulations for advisors who only give advice without selling products or without having the ability to manage investments. This is again because the giving of financial advice has not been its own standalone business. Therefore, its regulation is basically bolted on to the existing regulation of insurance agents, security brokers, and/or investment advisors. As I mentioned in the first video, things get muddy when an advisor holds licenses or regulations from across the 3 different forms of regulatory bodies. This is more common at the large national firms. Those places are designed to maximize the opportunities to provide products and services, otherwise known within the industry as cross-selling. For example, think about a bank that is also affiliated with a brokerage company and an insurance company. They want to be a one-stop shop for all things financial. The bank can provide you a mortgage to buy a house, and they may have an incentive for you to get a lower mortgage rate if you open up a brokerage account through their affiliated brokerage company. And they may have investment advisors who can give you advice on that account. And maybe the fees they charge for investment advice are reduced if you open up a checking or banking account through their bank. And now to tie it all together, you can buy life insurance through their affiliated insurance company to protect all the other products and services you just bought. In order to legally be able to offer and sell all these different things, advisors need to be licensed and regulated in multiple ways. But if they are, how do you know when they're acting as product salespeople only beholden to the suitability standard, and when they're acting as investment advisors beholden to the fiduciary standard? It depends. They can basically wear different hats at different times. Think about it this way. If the advisor is using discretionary judgment to decide which mutual fund to buy inside your brokerage account, then he or she is acting as an investment advisor and is giving you investment advice which legally has to be in your best interest. But then the advisor starts discussing life insurance with you. Then the investment advisor hat comes off and the insurance agent hat comes on, which means the standard of care just switched from that of a fiduciary to only having to act suitably while consummating the sale of the insurance product. While some of the large national financial service companies do kind of try to be all things to all people, many of the small and mid-sized advisory companies do not. While some advisors might focus on selling insurance or securities or just managing investments, many advisors focus on what's called financial planning, which is the comprehensive advice about all aspects of your financial life. More and more firms are trying to expand their offerings to be financial planners and not just product salespeople or investment advisor, because it's increasingly clear that the real value in financial advice is being able to provide it on a comprehensive and holistic basis. You can't really make good financial decisions when you're looking at each part of your financial life in isolation. Decisions need to be made in consideration of how each decision will impact all the other parts of your financial life. That's financial planning. On the other hand, some advisors may have very targeted focuses by honing their experience in particular subject matters or in working with certain client types. For example, some advisors focus on just retirement planning, college funding, federal benefits, stock options, or international taxation matters. As for client types, I know of advisors who only work with dentists, commercial pilots, teachers, women in transition such as divorce, and professional fishermen. The different types of advisors are also compensated in different ways. In all cases, the advisors may receive some sort of base salary from their companies, but in terms of how the company gets paid from you, the client, it's either by sales commissions or advisory fees. Insurance agents and securities brokers are paid by clients by way of commissions associated with the products they sell. Sometimes those commissions are clear, such as when a securities broker sells a mutual fund that has what's called a load, which is just a fancy word for commission. As an example, if you buy a mutual fund with a 5% load, that means for every $100 of fund you buy, only $95 of it actually gets invested. The other $5 is paid to the broker and or the broker's company as a sales commission. Mutual fund sales commissions like this used to be real common and accepted. Now, there are a wide array of great no-load mutual funds, which means funds that don't have a sales commission. No-load funds have since become the standard, but loaded mutual funds for some reason still exist, and people still buy them. But in my opinion, I see virtually no reason for anyone to have to buy a loaded fund at this point. Other commissions are not so obvious, like in the case of term life insurance. When you buy insurance, you're quoted a monthly or annual premium amount you'll have to pay for the life of the policy. The policy doesn't directly spell out how much commission the selling agent will receive. Instead, some portion of the premium you pay to the company ends up getting paid to the agent as a sales commission. Investment advisors directly charge fees to clients. There are no commissions. Investment managers typically charge clients a percentage of the assets managed. Some may instead charge flat fees, hourly fees, and so forth. This is particularly true for advisors who give advice that is not tied to investment management. It's also helpful to know the meaning and difference in the alphabet soup of letters many advisors have after their names. These are all various professional designations. There are dozens, if not hundreds, of designations out there, but in my opinion, there are only a handful that are common and or meaningful. I break down the various designations into one of two classifications. First are what I call major designations. These are ones that require serious commitments of effort, time, and or money to earn and maintain. Second are minor designations, which are easier to obtain than major designations. Keep in mind these classifications are just my subjective views on what's major and what's minor. I also made up the terms major and minor. Those aren't official industry terms for these designations. Other advisors in the industry are likely to have different opinions about how serious or meaningful these designations are. And also keep in mind all the designations I'm about to discuss are completely optional. They're not required licenses or regulations. Unlike a Series 7 in the securities brokerage world, you need that license before you're legally allowed to sell a security. That's not the case with these designations. They're all voluntary, but they demonstrate an advisor's commitment to increased knowledge and professional acuity, so they're important to understand. Also, there are different organizations and bodies which sponsor and govern these designations. Like most other aspects of the financial advice world, there unfortunately isn't a single group which oversees the creation and policing of these designations. This means there are often nearly identical designations offered by competing organizations. It's a shame things are so fragmented, but it is what it is. The first of the major designations are those focused on comprehensive financial planning. While there is no single best designation per se, the Certified Financial Planner designation, or CFP, is becoming the de facto gold standard of financial planning and knowledge and experience. There are also the Chartered Financial Consultant and Personal Financial Specialist designations. Next are tax-focused designations. I'm sure everyone's heard of a Certified Public Accountant. That's a credential overseen by each state's respective Board of Accountancy. The IRS issues and oversees its own tax credential known as Enrolled Agent Status. For investment management, the Chartered Financial Analyst designation is hands down the gold standard. In the life insurance world, the Chartered Life Underwriter is the marquee designation. This is also one of the oldest designations. As discussed in my first video, I assume it's because financial advice basically started in the insurance world. For estate planning, the accredited estate planner designation is the most common. As for the minor designations, there are way too many to mention, but here are the few that you're most likely to see advisors have. While not nearly as rigorous as the Chartered Financial Analyst designation, the Certified Investment Management Analyst designation also focuses on investment management. There are two competing designations for wealth management, which you can loosely think of as comprehensive financial planning, but with a focus on high net worth clients. Those that are likely to have more complex estate planning and insurance needs, or where charitable giving is a larger focus, and so forth. Those two designations are the Certified Private Wealth Advisor and the Wealth Management Certified Professional. There are also two competing designations for retirement planning, which is financial planning focused on making the most of your income in retirement. Basically, once you've spent your life building a nest egg, retirement planning is the practice of helping you best use that nest egg. The two retirement planning designations are the Retirement Income Certified Professional and the Retirement Management Advisor. There's also a designation which focuses specifically on the financial intricacies of divorce. That's the Certified Divorce Financial Analyst. Finally, there's also a designation which covers Social Security, the National Social Security Advisor. I should separately add that some of the professional designations carry their own fiduciary requirement, but in my opinion, the requirements of a voluntary professional designation do not hold as much weight or legal strength as those mandated by regulators. The CFP credential is one in which members take an oath to always act in the client's best interest. But this is where it gets interesting. Advisors who are only salespeople are required by their governing regulators to act in their company's best interest. Recall they only need to provide recommendations or products that are suitable for clients, not in the client's best interest. In this case, the requirements of the CFP designation may conflict with those of the salesperson's underlying regulatory, legal, and/or company requirements. Because of this potential confusion and conflict, some of the large brokers, all of which are huge national names you would have heard of, are requiring their advisors to drop their CFP designations. Now, if that doesn't scream, "We don't act in your best interest," I don't know what does. So now that you understand all the differences in the various types of financial advisors, you can start to search for one whose regulations, background, compensation methods, and so forth match what you're looking for. But first, I have to discuss a bit about conflicts of interest. While there are ways to minimize conflicts of interest, there's no advisor model that is 100% free of potential conflicts of interest. For example, advisors who are compensated mainly or solely from commissions are obviously incentivized to sell you products. But this doesn't mean salespeople are the only ones with conflicts of interest. Investment advisors may be inherently biased to have you keep assets invested with them instead of use them for other purposes such as paying off your mortgage. Now, legally, investment advisors are required to act in your best interest. With that said, if it would truly be better for you to take a few $100,000 out of your investment account to pay off your mortgage, the investment advisor is supposed to advise you as such. But practically, assuming the advisor charges 1% of assets under management per year, that means the advisor would be giving up a few $1,000s a year of revenue. You can see where the conflicts could arise. Even for investment advisors who don't manage investments, it doesn't mean there are no potential conflicts. As an example, hourly financial planners may stretch out your engagement longer than it needs to be to charge more fees. Again, they're not supposed to because they're legally required to act in your best interest, but you can see where conflicts may arise. I would next like to discuss a bit about the term fee only. Fee only advisors are those whose compensation comes solely and directly from the client. Fee only advisors are not allowed or even able to earn any sales commissions or other production related incentives or bonuses from anyone other than the client. With that said, fee only advisors are regulated solely as investment advisors and not as insurance agents or securities brokers, because by design, insurance agents and securities brokers sell products for commission. So it's not possible to have any insurance or brokerage licenses or affiliations and call yourself fee only. The fee-only movement has been gaining traction as consumers increasingly recognize the value in real advice and not just product sales. Recognizing fee-only is starting to resonate with people. Many non-fee-only firms have been getting cute with their marketing and call themselves fee-based or something along those lines. But fee-only is different from fee-based, fee and commission or hybrid fee structures where advisors charge fees directly to the client and can also earn commissions from product sales. Furthermore, some advisors call themselves fee only because they don't sell any insurance or securities even though they hold licenses to do so. However, that's not allowed. Even if you don't actually sell such products, simply having the licenses means you can't call yourself fee only. Well, that's it for part 2 of how to find a financial advisor. I hope you found it valuable. Don't forget to watch part 3, which is the final installment in this series. In it, I provide 5 different valuable search tools to find the best financial advisor for you. I also give some other helpful tips and info, such as how to see if your potential advisor has had any prior complaints or regulatory violations. Thanks for watching. I'll see you soon.